Mark, good morning to you. Let's have 3 minutes on the markets then. And a lot of the negativity easy to attribute to Oracle. NASDAQ futures are down more than E-minis, for example, and that's a focus for tech. But you think there's something more negative about the Fed that maybe that narrative ignores?
Yeah, definitely Oracle has been a driver of negativity today. Now, it was slightly delayed reaction in terms of Asia because it was after SoftBank also fell on the Oracle story that Asia got a little bit more negative about it. But I think that people are also a little bit more disappointed by the Fed. The narrative in real time, and I was kind of following the coverage in real time, was that this is, definitely good for stocks into year end. It wasn't as hawkish as it could have been. And they're buying Treasury bills. And this is in the context that, the Treasury is issuing Treasury bills to kind of juice the economy, and the Fed's buying them. That's obviously quite good for financial assets. So this was seen as generally positive for the stock market. The price action today has been a bit more negative. Now, it could be just a little bit more of, buy the rumor, sell the fact event. But I think also people are realizing that, we just don't have any certainty on policy next year. And I think that's maybe kind of gone, hey, with no certainty, we're going to a lower liquidity time of year. It's been a great year. Maybe it's just time to take some money off the table. And I think that explains some of the price action today.
OK. Can I just come back to the QE question? 40 billion. This sounds awfully like QE to me. And the market reaction, the market function, sort of reaction function over the last few years has been CQE, liquidity equals liquidity, buy risk assets. Isn't that all you need to know coming out of yesterday?
I think you're right, Guy, in terms that's the most important takeaway from yesterday. And look, as we've talked about a lot in this show, I think that stock markets go a chunk higher again in 2026. I think the backdrop is growth that's staying relatively resilient, an exceptionally supportive central bank from the Fed. We're getting fiscal stimulus generally around the world. And, we've got an administration that's trying to juice asset prices. And the AI bubble is still in the inflation stage. So I think stock markets go a lot higher. I understand, though, why investors aren't playing that on the immediate basis. And I remain in the camp that even though I'm kind of structurally quite bullish into next year, I think it remains difficult this side of Christmas. I'm not bearish, but I just don't think this is the time to get on board the bullish trade just yet.
The Fed is behind us. We've got these Oracle numbers, still working our way through that, and that'll have an impact on today's trade, Mark. But what are the events that are still left this year do you think is going to be the biggest focus for markets, or should be more of a focus for markets?
I think that's the problem, is actually there's a lot next week. I mean, normally kind of the Fed marks almost the end of the year, but it's a little bit earlier than normal. And then we've got ECB, Bank of England, Bank of Japan. These are all central banks that have something in play. As you know, I normally think ECB is boring, but it's not so boring as normal because of Schnabel's hawkish comments. Now, she is the most hawkish member of the board, but still the rates yields have really repriced there. Everyone's expecting a dovish cut from the Bank of England. Maybe it's a hawkish cut given how every other central bank's changing. We've got the Bank of Bank of Japan. They'll probably disappoint at the end of the week. And the labour report out of the US is even more important than normal, given what Powell said.